traders. Well, there was certainly some volatility last night. We had the US inflation numbers, 1.3% print for June, which put US inflation at 9.1%. That's pretty high, the highest it's been in 40 years. And that certainly sparked a fair bit of volatility. This was followed up a couple of hours later by a full 1 basis point from the Canadians. They were expected to do 75, pushing rates up to 2.25, and they got a full 100 basis points, or 1%. And that's what the Americans are looking at. There was a lot of discussion of whether they'll be doing 75 basis points or 100 basis points on July 28th. And at first the market thought they'd be doing 100, but then an article came out in the Wall Street Journal saying no, that's not on the cards, and then followed by a Fed speaker, Bostic, coming out saying everything's on the cards. So market as they were trying to digest that. And as usual, Tyler Durden from Zero Hedge puts it into perspective. We've got here now that the 2-10 spread, US 10-year, US 2-year over the US 10-year yield is the lowest, lower than it was in COVID. And as you can see, every time it goes under this or goes negative, you get a recession not long after, and we'll be looking for a recession early next year. As if they do 100 basis points in July, now there's talk of not only 100 basis points in July, but also 66% chance of 100 basis points in July, followed by 75 basis points in September. And that would push interest rates up extremely high and push us into a recession, or the US into recession. But then they're looking at rate expectations to be cut, and 100 basis point cuts in February next year. So this is what this red line is, what the average of the dot plot from the Fed as of 15th of June, where they expect interest rates to be sitting. And the black line is where the futures market, the bond market, is pricing interest rates. So a big drop at the end of next year, so from 3.75 down to 2.75 by the end of next year, and further falls into by the end of 2024. And all of that, we're looking at stocks here compared to, is there more downside for stocks? Yes, absolutely. Stocks are trying to decide whether or not they look through the rate hikes of this year and the expense that has on corporations, and look through that to the cheaper money or rate cuts in 2023, and that's good for stocks. They're trying to work through that, but this chart would suggest that there's more downside to come for stocks to catch up to where the rate expectations are. So quite a lot of volatility in the market, and we can see that with all of that, all the moves, the market closed in the middle, so undecided, right? So this is obviously in the FX market, we've got another 50 minutes to go, 49 minutes of trading for this session, but closing in the middle of the range, even on the dollar index in the middle of the range. So that's kind of non-committal, but we look at the hourly chart, we can see that volatility where the size of the bars are highly increased. So it ramped up and fell back down, and now starting to ramp back up again, closing in the middle of the session. We come to Euro, actually went through parity by a couple of pips on the news, 2 pips underneath, and ramped back up, but it's coming back down again to close again in the middle of the trading range. that doesn't give us much to work with when you get the market sort of undecided as to what direction it wants to go. Stocks, similar story. We've got NASDAQ, hourly, a lot of volatility around the number, but closing again in the middle of the day's range. S&P 500 closing in the middle of the day's range. Closed 12 minutes ago, the cash market anyway, closed, and now this little bar here is the 12 minutes of the aftermarket. But again, you can see that volatility and then closing in the middle of the range. So, well, I'm short, so of course I want the market to fall, but with now 100 basis points more than likely in 2 weeks' time, on the 28th, and we're more than likely to probably get a sell-off in the market, and we still haven't really seen panic in the stock market. Down here is the 20% bear market, and we dipped under that briefly, but well, we can work it out, I guess. What's 47.82? It's 956. The high is 4817.3. 4817.3 multiplied by 0.2 is 963.46. So 4817.3 minus, what was it? 963. Can't remember my numbers. 4817, 963. 3854 is the bear market, right? So we're in bear market territory, 20%. That's 20% from the highs is bear market territory. And yeah, I think panic hasn't set in the market, or if it is, the bear market's only just getting started. Just briefly, we'll go into commodities, and again they're non-committal. We've got oil a little bit weaker, but closing in the middle of the range, sort of settling under $100. Gold non-committal, gold non-committal, a little, maybe a bounce, but sort of stuck under that. Copper, a bit of a bounce, and then we come into the softs, and it's a mixed bag, so a little hard to sort of weakness in some and strength in others. A little difficult to try and find a direction here when it closes in the middle of the range. That's non-committal, so it doesn't give you an idea of the direction. We are at the extremities of price from the moving averages, and also in our momentum indicator being over exhausted. Aussie dollar's not, so that would suggest there's potentially more downside for it. Similarly with the Kiwi and the CAD, there's potentially more upside for it. It's just a tough one to read. Trying to buy this back up, big set of kahunas to do that. I'd still prefer to be short the euro. You think the US is in a lot of problems, then need to have a look at the euro picture, which is even worse. Also got high inflation. They're not exactly raising rates yet to try and combat that, but economically the economy is not doing that well. So yeah, I find it hard to try and buy the euro right now, and you're trading against a hell of a lot of momentum. The only thing really supporting it is the psychological barrier of this parity, and there seems to be an oversupply of buyers there at the moment, trying to soak up all that selling pressure. And yeah, if if it does push through, then those buyers will become sellers and it'll accelerate further lower. But we might get a bit of a bid up back up to this neckline. It's just I wouldn't trade it. To me, it's too high risk. So for right now, I'm happy with the positions I've got on, and I'll just wait for the next opportunity, because I don't really see one here today or for the rest of this week, to be honest. We've got Australia's unemployment data coming out today. Looking for 30,000 new jobs. Unemployment rate's 3.8%. That's purely because we haven't been importing migrants at the rate that we were pre-COVID. So there's a lot of jobs, a lot of industries that are screaming for more employees, but they're just not getting them. So very tricky. I think it's best to probably trade with a lot of caution at the moment. All the best, guys. Stay safe. Keep a tight stop.